So this is no joke. Hey guys, it's Eric from Hong Kong based in Germany. I've been investing since I was 17 years old for almost 20 years. I want to give you guys alternative perspective about investments related to Asia. Today I'm going to talk about the company that killed Uber in China, Didi. Didi is one of the 5 biggest startups that are still privately owned, and finally we have a chance to invest in it. It's going to list on New York Stock Exchange as soon as 30th of June, with the ticker of DIDI. It will be the 6th largest IPO in the US in the past decade, only to be superseded by the likes of Facebook, Uber, and Alibaba. It is also the largest IPO by a Chinese company in the US since Alibaba in 2014. Didi plans to raise up to $4 billion in the IPO, valuing the company ranging from $62 to $67 billion, which is far behind its original plan of $100 billion. By the way, I mentioned IPO many times, right? If you do not know what is an IPO, please check out the links above or in the description below. I have a playlist talking about IPOs. Well, even 62 billion is quite a lofty valuation, right? What exactly does Didi do? Didi was established in 2012 as a rival to Uber, basically a ride-hailing app, a platform to connect passengers and drivers. It has 156 million monthly active users, 13 million yearly active drivers, and you know what? 25 million transactions per day. It's pretty impressive, right? It has a market share of 90% in China. Yes, 90. It is definitely the leader in the industry, and as you heard from the number just now, it is humongous. However, it is not all nice and rosy. The first risk is that they're actually not making money. In 2020, out of $21.6 billion of revenue, they were losing $1.6 billion. Well, even though in the latest quarter, they made a profit of $95 million out of the $6.4 billion of revenue, it is yet to see whether this is sustainable, because it could be some kind of accounting tricks for the IPO. The second risk is that, as very often in China, is the regulatory risk. Among the 34 tech companies being warned by the regulators in China not to follow Alibaba's footsteps. Well, if you guys know, Alibaba was fined a world record sum of $18.2 billion for antitrust behaviors. So this is no joke. Didi is the obvious target in its sector. Alongside Meituan and other competitors, it was explicitly warned to give fairer pricing to the drivers and to have better transparency on pricing to the customers. By the way, I made videos about Chinese companies, including Meituan and Alibaba. So remember to subscribe now. Even better to click the bell button next to the subscribe button so that you're not going to miss out any of the videos. Okay, so where we are. The third risk is arguably the highest risk, growth. As with Tesla, BYD, Meituan, and many other companies, the high valuation is based on growth. But what if the growth potential is not there anymore or is not as high as before? The problem with Didi is that they already have 90% of the market share, and the growth rate was 5% per year in 2018 up to 2020. So with such a high base number, it's very difficult for it to continue to grow very quickly. In summary, Didi is the company that kicked Uber out of China. It has scaled operations talking about tens of millions of people. Also, it started to make profits the latest quarter. However, we are not too sure whether it can continue to make profits in the longer term. Also, there's the regulatory props, antitrust props hanging in the air, let alone that the growth might not be able to sustain in the near future. However, even Morgan Stanley is opting for up to $750 million worth of share from Didi. Also, Temasek, the sovereign investment fund of Singapore, aimed to have up to 500 million of shares from the IPO. So I guess it's not too bad, right? Personally, I also think that it is worth investing in Didi in the long term, talking about 5 to 10 years, as long as they can prove their business model work and they can make profits sustainably. After all, the ride-hailing market in China is still growing and is going to be very, very big. But for now, I'm not going to invest into it right after the IPO because I believe that it will go down for the factors I mentioned just now. So what do you think about Didi's IPO? Are you going to invest now or are you going to wait and see? Leave me in comments below. If you like the video, remember to like and subscribe. Even better, click the bell button next to the subscribe button. It will be a great motivation for me to continue making videos and making them better.